Traditional finance treats personal wealth like a flawless mathematical equation. You input income, subtract expenses, calculate your yield, and arrive at a perfectly predictable outcome. But that flawless logic fractures the moment it hits reality. Spreadsheets do not feel fear during a market crash. They do not feel greed during the bull run, and they certainly do not feel envy when a neighbor buys a new car. People rarely ruin their financial lives because they can't do the math. They lose their money because human psychology overrides their intelligence. This disconnect birthed the field of behavioral finance. Researchers realized that instead of acting like rational economic machines, humans rely on mental accounting to justify bad purchases and herd behavior to copy whatever the crowd is doing. When panic sweeps through a crowd, rational models fall apart. Investors will sell off perfectly good assets at massive losses simply because everyone else on the floor is doing it. In these high-stress moments, a cascade of cognitive biases takes over. We anchor our expectations to irrelevant past prices. We fall for hyperbolic discounting, favoring a quick reward today over long-term security. And when the numbers look bad, we employ the ostrich effect, burying our heads in the sand and refusing to look at our accounts. Memorizing compounding formulas and tax codes is useless if your strategy cannot survive the stress test of your own emotional impulses. Modern society trains us to measure success through visible markers: luxury cars in the driveway, massive homes, and high-status job titles. This creates what author Morgan Housel calls the man-in-the-car paradox. When you see someone driving a very high-end sports car, you rarely look at the driver with admiration. Instead, you imagine yourself in the driver's seat, assuming people would admire you. Purchasing expensive items to command respect from strangers satisfies your ego, but it does absolutely nothing to secure your financial future. There is a stark difference between being rich and being wealthy. Being rich means having a high income and spending it loudly. True wealth is invisible. It is the unspent money, the investment portfolios, and the assets quietly sitting in the background. This chart shows a common trap called lifestyle creep. As income grows, your ego inflates with it. When the income bar goes up, expenses rise to match it, leaving a savings gap of zero. You build a more expensive cage, but remain trapped inside. You end up caught in a behavioral paradox. Spending money to show people how much money you have is the absolute fastest way to have less of it. This cycle of chasing status isn't just a personal choice. It fuels a broader economic structure. On one side are the consumers who spend their lives funding other people's empires, and on the other are the producers who actually own them. We live in an automatic economy rigged to extract wealth from consumers. Through endless subscriptions and targeted spending, corporations optimize for the maximum lifetime value of your wallet. This flowchart shows the mechanical difference between those two lives. When income cycles exclusively into bills, net worth stays at zero. To build wealth, capital must move into a separate box, filled with assets that grow even when you aren't working. Leveraging heavy debt to maintain a status-driven lifestyle works right up until an economic shock hits. When the market turns or a job is lost, that facade of wealth collapses instantly. Competing on the envy escalator keeps you in a state of permanent vulnerability, where a high-status lifestyle is essentially a house of cards that falls apart if you stop running for even a single month. The only reliable solution to our psychological flaws is removing human decision-making from the process entirely. We have to protect our wealth from our emotions. You do this by treating savings not as an afterthought, but as an automatic, non-negotiable expense, extracted before you even see the money. You set up a system where a specific percentage, like the first hour of your daily income, flows directly into diversified index funds. Multiply your yearly expenses by 25 to calculate your freedom figure. Here, you can safely withdraw 4% annually for life. Once running, compound interest takes over. The capital grows exponentially in the background, multiplying itself year after year without requiring any new input. This automated engine isn't designed to beat the stock market. It is designed to survive your own worst impulses. Accumulating this capital is not about eventually buying a private jet or a massive estate. The true purpose of wealth is to purchase autonomy. The highest dividend money pays is the ability to wake up every single morning and know you completely own your schedule. Historically, rich titans like Cornelius Vanderbilt were completely beholden to the intense demands of their empires. They had massive fortunes, but lacked true day-to-day freedom. True wealth remains invisible. It is the luxury cars you didn't buy, the first-class upgrades you skipped, and the money you quietly saved to buy options for your future self. By controlling your psychology and automating your investments, you stop using money to impress people who aren't watching. Instead, you use it to buy back your own time, transforming your bank account into a foundation for a life entirely on your own terms.